The New York Fed just confirmed subprime auto delinquency is at its worst level since 1994. Repossessions are now on track for 10.5 million this year, 50% higher than the 2009 peak. Here's the full story and how it hits you, even if you don't owe money on a car.
3 million American vehicles are on track to be repossessed this year. That is 50% higher than the worst point of the Great Recession. No recession has been declared. No major automaker has filed for bankruptcy. The current repossession trajectory already exceeds the 2009 peak, and the cycle has not officially turned yet. If you have an auto loan right now, the NY Fed just published where you sit inside that number. Today, you are going to find out what the federal data actually confirms, which named lenders are already absorbing the losses, how the 84-month loan keeps the trap locked whether you see it or not, and 3 moves to make before your next refinance or purchase. Total U.S. household debt hit $18.8 trillion in the first quarter of 2026. Auto loan debt alone stands at $1.685 trillion. New auto loan originations in Q1 2026 were $182 billion, meaning new borrowers are entering this market at full volume, while the existing book deteriorates underneath them. Fitch Subprime 60-day delinquency hit 6.9% in January 2026, the highest reading in the 31-year history of that data series. The Fitch heat map has been deep red for nearly 4 consecutive years. 30.9% of trade-ins in Q1 2026 were underwater with an average negative equity gap of $7,183. Both figures the worst since Q1 2021. That is not a fringe condition. That is the NY Fed confirming where tens of millions of borrowers are sitting right now. The payment data explains how they got there. The average new vehicle monthly payment in Q1 2026 was $773. Median gross monthly income for a full-time U.S. worker sits at approximately $5,350. That is 14.4% of gross income on the car payment alone, before rent, before groceries, before health insurance. For buyers who rolled negative equity from a previous loan into a new purchase, the average payment hit $932 per month, a Q1 record. That is 17.4% of gross income on a depreciating asset. 26% of underwater trade-ins carried more than $10,000 in negative equity. 9.3% exceeded $15,000. 19% of all new auto loans are now at or above $1,000 per month, 3.5 times the rate from 5 years ago. Jessica Caldwell, Edmunds AVP, confirmed the average down payment for underwater buyers is just over $2,000 on a financed amount of $55,970. That is a loan-to-value ratio that would make a mortgage underwriter walk out of the room. The 84-month loan is what keeps the trap locked once you are in it. You sign because the monthly payment looks manageable, but the car depreciates faster than you pay down the principal for the first 3 to 4 years. When you roll $7,183 of negative equity into a new 84-month loan at a subprime rate, the amortization schedule means you are underwater again within 18 months on the new vehicle. The gap closes slowly at the tail end of an 84-month term, not at the beginning. Every payment in the first 2 years produces minimal equity reduction because the interest front loads the amortization. You are paying to stand still. By the time you want to trade again, you are underwater again. You roll the gap into the next loan. The cycle repeats. 90.2% of loans with rolled negative equity carry 72-month or longer terms. 43% extend to 84 months. The industry designed this product knowing the math. The named lender charge-off data confirms the loss is already moving from the borrower to the balance sheet.
Hey everyone, real quick, if you want to learn how to buy Bitcoin, XRP, or any crypto, but you want to learn how to do it safely, efficiently, not lose your money, and be smart about it, links down below to the crypto bundle, Bitcoin 101 course, and the crypto security course. Links down below, one price, Now let's get back to this video.
Ally Financial reported Q1 2026 retail auto net charge-offs at 1.97% with a $467 million provision. GM Financial reported Q1 2026 net charge-offs at 1.5%, up from 1.2% the prior year, a 25% year-over-year increase. These are not fringe subprime shops. They are two of the largest auto lenders in the country, and both are bleeding. The subprime ABS pipeline remains open. Behind those charge-off numbers, Bridgecrest Blast 2026-1 priced at $646 million. Blast 2026-2 at $642 million. Exeter 2026-2 at $739 million. Santander Drive 2026-1 priced. What that pipeline means is that lenders are packaging these stressed loans into securities and selling the risk to bondholders. The losses do not disappear, they transfer. Cox Automotive promoted their chief economist, Jonathan Smoke, out of the chief economist seat in February 2026, replacing him with Jeremy Robb at the exact moment the delinquency data went vertical. The institutional framing and the federal data were moving in opposite directions at the same time. The 2008 to 2009 GMAC and Ally Financial bailout is the reference point. GMAC received $17.2 billion in TARP money beginning the week of December 29th, 2008. In Q2 2008, GMAC had already posted a $2.5 billion loss, including $716 million in lease impairment as used vehicle prices fell sharply. On December 24, 2008, GMAC converted to a bank holding company to access Federal Reserve liquidity. General Motors and Chrysler filed for bankruptcy in 2009. The repo cycle at the trough of that crisis peaked at approximately 1.9 to 2 million actual repossessions. The 2026 repossession trajectory of 3 million or more is 50% higher than that Great Recession peak, without an official recession declaration, without unemployment above 6.7%, without a major auto manufacturer in bankruptcy. The 2026 trajectory exceeds the worst modern cycle before the cycle has officially turned. Before that cycle turns further, here are 3 moves to run before your next refinance or purchase. First, calculate your loan-to-value position before doing anything else. If you do not know this number, you cannot make a rational decision about your next move. Get your current outstanding balance and look up the current Manheim trade-in estimate or KBB private party value for your specific vehicle. If the balance exceeds the value, you are in the 30.9%. Do not roll into a new purchase until you know exactly how large the gap is. Rolling $7,000 of negative equity into an 84-month subprime loan produces a first-year interest payment that exceeds the gap itself. You are not solving the problem, you are paying to make it larger. Second, if you are underwater, hold the vehicle. Every dollar of negative equity you roll forward extends the trap by years, not months. The average age of trade-ins with negative equity is 4.3 years. The math does not work at 4 years on an 84-month loan. Time and additional principal payments are the only tools that close the gap without extending it. A functional car you already own is worth more than a new payment you cannot afford to exit. Third, before signing with any lender on a new purchase, pull that lender's SEC free writing prospectus on Edgar. Bridgecrest, Exeter, and Santander Drive all file these publicly at no cost. Look at the delinquency rates on prior pools from the same issuer. If the prior pool delinquency rate is above 4%, the existing book is already stressed and the terms on your new loan will reflect that risk, whether the finance manager tells you or not. Calculate the total interest cost over the full new term before the payment sheet is presented. An 84-month term at 12% APR on a $35 balance produces total interest that exceeds the vehicle's projected residual value by year 5. The monthly payment is the number the industry wants you focused on. The total cost is the number that tells you whether the loan helped you or extended the trap. The repo trucks are already routed. 10.5 million households are on the assignment list this year. The NY Fed published the delinquency data. The fifth series is at a 31-year high. The lenders are packaging the losses and selling them to bondholders. Every number in this video was available before the cycle turned in 2008, and most people read it after. The question is not whether the data is there. It is whether you pulled your loan-to-value number before the recovery agent pulled into your driveway. Economic Ninja is out. Stay ahead of the data before the cycle turns.